विजय जी आवाज आ रही है?
Yes, yes. Welcome again to all the participants. Now, Naveen Khandelwal ji has joined this session on overview of valuation. So sometimes the topic is theoretical or there may be some boringness. So we have changed the topic as well as the speaker. Even if the speaker is good, but if we read this, read and listen the theory whole day, definitely it will not be easy for everybody to sit at 8 hours or 9 hours continuously. CA Naveen Khandelwal is a chartered accountant as well as registered valuer and insolvency professionals from Indore, and has taken session almost 7 to 8 RVOs, including our RVOs, since first batch itself. So welcome Naveen ji. And now you are in charge of this session. I made you the co-host as well. So whatever rights regarding mute, unmute, all rights you have. Sir, your voice is not coming. Sir, you are not audible. Naveen ji. I think no. Sir, please unmute.
आवाज आ रही है?
Now, yes, now it's okay.
मैं बोल रहा था मुझे लैपटॉप से भी राइट दे दीजिएगा.
Okay. Actually, there is a echo in your voice.
नहीं, अब नहीं आएगी इको.
Now it's okay.
हाँ. तो लैपटॉप से भी राइट दे दिया आपने?
Yes, yes, yes. Now it's okay.
Okay. So good morning, friends. Welcome to the
morning,
world
sir.
of,
good morning.
Yeah. So welcome to the world of valuation, and this is your first day for this valuation course, and I believe that it will be an exciting journey for next 6 to 7 days, where you will be going through on a different horizon, different landscape of the world of valuation. Obviously, there will be some common things which you have already gone through during your practice, your experience as a practicing professional also. But yes, there will be a new different dimension to the whole approach of valuation and other things. So today what I'm going to cover is valuation approaches, which forms the basic of how to do valuation going forward. And probably the future classes will be based on this concept only, where a lot of practical concepts will come in based on the valuation approaches which we are going to discuss today. And tomorrow again, when I'm going to come back and discuss some of the specific situation valuation, I'll be again using this concept to solve certain questions. So from exam perspective, this is the base for the whole valuation world, and that is why you need to concentrate on these concepts. Though the concepts are very common, very commonly understood, applying the basic logics of finance, but again, we just want to reiterate and apply it specifically to the world of valuation. So let me start with the whole concept of valuation, and in the next 2 hours, we'll be covering the theoretical and the formula part. And because we have a lot of other sessions which will be covering the practical part of the valuation, covering the basic concepts of this valuation approaches. So friends, we all understand that when we talk about value, probably people get confused with the word value and the price, and therefore a lot of extraordinary people, learned people have tried to differentiate between the word value and the price. And to put it in a very fine words, that what is value and what is price, it is very important to understand the concept of business valuation and what is the process of business valuation. So when we talk about business valuation, be it any company, a small, big, listed, unlisted, or whatever, I think it is a process of determining the value of the business, business ownership interest, security, or intangible assets. That is what the International Glossary of Business Valuation terms and define. Uh, to put it in very simple words, it is more of a very logical and rational approach to find out the worth of the business. See, there are two words: worth, the value, and the price part. So, value determines the worth of the business, and we all know it is not necessary that the price which is reflected in the market may reflect the worth of the business. So, therefore, friends, it is very important to understand some disturbances from some. Yeah, no, it's okay. So, friends, very important to understand when you become a registered valuer, probably you need to tell people, educate people that yes, what we are trying to determine is the value, not the price part, because price is subject to certain market things, and valuation is based on the intrinsic worth of the business. So, so value is a measure of how much an asset is worth. That is the important thing, and it's more of an economic concept, and it is based on a particular point of time. The price at a given point of time, and we understand that the values may change over a period of time. There's some disturbances from somebody's mind.
Now it's okay. It was with Ramanji. Now I have meeting him.
Fine, right. So the value is basically on a given given point of time, and we all understand that over a period of time the value may change, because value is based on different assumptions, different consideration, and those assumptions and consideration may change, as we all know that in the current scenario, pre-COVID and post-COVID, because of the business is there, the business remains there, but because of the market assumptions, the consideration have changed. We understand the value may change. So, friends, valuation is altogether a process for or a method of computing value. Remember, so we need to follow a particular process. While price is never a process, price is purely based on that particular instant period of time. That is the major difference between price and the value. So, to put it in more appropriate words, maybe relevant from exam point of view, that what could be the possible difference between price and value. So, price is basically an outcome of a transaction. So when there is a deal is done, when you have purchased something, when you have sold something, so whatever price you have sold or purchased, that is basically the price, and which is basically an outcome of the transaction. And price is exact measure, remember, while value is not an exact measure. That is again a major difference which we need to understand. And in general, you may find that the price may or may not have a relationship with the value of the underlying asset. So price is a derivative of value. Very important, friends. Price is a derivative of value, and it may be more than the value, may be less than the value, because it may be dependent upon the market forces also. So very important, friends, to differentiate between value and price, so that going forward, you can always tell that we are trying to value the company, not trying to calculate the price of the particular company. And maybe the transactions may take at that particular value which you have determined. So that will become a price once that transaction takes place. But when you are trying to determine the worth of the business, you are trying to determine the value, not the price of that particular company. And a lot of myths are there regarding the valuation part, and therefore Mr. Damodaran is known as the god of valuation, a very renowned and learned person. And he has mentioned in his write-ups that what are the common myths which people have regarding valuation, and we need to remove those myths. Since valuation models are quantitative, which we all understand that going forward, we'll understand that all valuation are based on quantitative model. Therefore, valuation is objective. Now, let me tell you, friends, valuation cannot be very objective. Models may be quantitative, but inputs are subjective, because models are based on the inputs which we are trying to feed into that particular model. Model is just the final outcome of all the research, but then the outcome will be dependent upon the inputs. So inputs which derive, which are fed into the whole models, they are subjective, and because inputs can vary from a lot of sources, therefore it is subjective. So therefore we cannot say that valuation is objective. When you do a valuation, you will find that you need to do a lot of research. And when you do a lot of research, then the model becomes a timeless model. But that is a wrong myth, friends. It cannot be. It cannot be the same. Whatever we have determined today may not be the worth tomorrow. So values will change over a period of time as new information are revealed. And a good valuation provides a precise estimate of value. No, not necessarily, because by valuation we have to incorporate a lot many assumptions which may not be valid on that particular date. So it is not a precise estimate of value. The more quantitative a model, the better the valuation. Yes, it can be, but then it will all depend upon the type of input, the type of information which you collect. So we cannot just say that the more intricacies and complexities are involved in a model, so the valuation could be more precise and accurate. It may not be the case. So, and market is generally wrong. That is normally what we see. Looking to the current trend, when we see that the whole economy is going on a downtrend, but the stock market is something talking something else. So you cannot say that market is generally wrong. But yes, the presumption that should be that the market is very appropriate and is correct, and that is up to the analyst to prove their valuation of us a better estimate. So it all depends upon you, that how you justify that whatever value you have derived is more correct rather than the market. But as of now, if you see in the common context, we all are driven by the market forces, and people believe more in the market forces, that whatever market is saying, that we have to take it, because transactions take place at the market price. Maybe what you are trying to tell is value, which may be different altogether from the price which is relevant in the market. So the market is generally wrong. That is a wrong myth at times. Okay, friends. So that, after creating that base and concept, that whatever we are trying to determine, whatever we are trying to calculate, is not an exact estimate, but just generally an opinion regarding the worth of the business. So let us go through the various methods of how do we determine the worth of the business. Now, in general, if I ask you that, friends, how do you determine the worth of the business? I think everybody, because we all are educated, we all have learned so many things. Probably everybody will be saying that it all depends upon the business, the nature of business, the financials part, the capital structure, the future part, and so many things. But yes, clubbing all together, we have people have devised certain an objective way of trying to find out that particular value. And it is up to the valuer to use these valuation methodologies based on the nature of the business, the type of industry, and so on. So whatever we are going to study is a well researched objective based techniques which have been derived, and probably it has now been a proven fact, accepted methodologies, and therefore as per the valuation standard which you are going to study in due course of time, probably all those valuation standard do refer to only these methodologies to determine the value of the business. So friends, this is basically the crux, the base of determining the value of the business. Now, what are the basis for all the valuation approaches? Whether we follow the first, second, or third approaches, the basis is normally the same. So they are based upon the perception that markets are inefficient and make mistakes in assessing value. That is very correct, which we have to assume. Because markets can never be efficient, which we all have studied, that an efficient market is an ideal condition, which we all foresee, which we all believe that it should be like that, where we don't believe in speculation. But the fact is that markets cannot be efficient. And then the second assumption, that about how and when these inefficiencies will get corrected, very difficult call, very difficult to say that these inefficiencies in the market could be rectified, because if one is rectified, the other may crop up. So we cannot say that you will have an ideal condition. And in an efficient market, whenever the market becomes efficient, then what we can, assume, that is one of the corollary which we can derive is that the market price may reflect the best estimate of value, which will in fact happen over a period of time if the market becomes efficient. Because the market should reflect the worth of the business, which is not the case today. But going forward, if we foresee that, the markets will become efficient, then the market price will be the best estimate of the value. Then probably the method which we are follow will be actually justified by the market forces. Okay, so coming to the valuation methodology is very important, friends, very important. And these are all exam relevant points. And we all are here to clear their exams. And let me tell you, friends, because it is just the start of your valuation course, just to pep up the energy, the attitude towards this particular exam, are there good prospects on the whole valuation world? Anybody can give me feedback on the same? That we foresee a positive outlook for the whole business, for whole valuation profession?
Can you please repeat your question, please?
Do you foresee a good prospect for the valuation profession?
Yes, of course.
So Mr. Raman is saying yes.
Yeah.
Any other person who believes that the profession, the outlook is very good, and why? That is very important to be understood.
Yeah, I think in a vibrant economy where the economy is growing,
Yes.
obviously there will be a lot of
Yes.
Okay, Mr. Siva is saying that there's a vibrant economy.
in a economy, when businesses are a lot of consolidation is happening, a lot of churn is happening in the marketplace, as well as the economies themselves are going through very uncertain periods. I think these will be the tools to be used for basic transactions.
Okay, good. Right. So Mr. Siva has a good different perspective. Mr. Raman has said yes, and Mr. Anuj was mentioning something. Yes, Mr. Anuj, do you have something to offer? No, nothing. Anyway, so friends, yes, with regard to the future prospect of valuation, I would say yes, there will be a good opportunity in times to come, but with a caveat. The caveat is that going forward, you should take this profession as a standalone profession in times to come.
Yeah.
Today, you might try to club it with your other existing profession which you are doing, but going forward, I think this will take a new shape and altogether a different domain, and where we need to specialize in this world, worldwide, because the way the markets have developed, and the valuation profession is regarded as altogether different profession. Today in the Indian market, what we have seen that we have chartered accountants, company secretaries, CMAs, MBAs, who have joined this particular bandwagon of becoming. Where we need to understand that with the changing laws, the economic scenario, this profession will become a standalone profession. So we need to prepare for that. And probably today what you are trying to get is a filler by entering into this world. And maybe over a period of time, maybe 2 years down the line, you may realize that yes, whether I need to explore this line further or not, that is the call we have to make. So keep that in mind, friends, that it will be a totally dedicated profession in times to come. Why do I say that? Yes, apart from whatever is happening in the economy, that is, apart from that, what is going to happen is if you are aware of the changes in the world of valuation, we have the new institute coming up, the Institute of Valuers. And when the new Institute of Valuers will come up, what is going to happen is that all professionals will come under that domain, as we have the existing Institute of ICI, ICSI, and CMA. We have this new institute, and where the laws, different laws in the country are having different outlook on valuation, and recognize different people for valuation. But going forward, once that institute comes in, probably all the laws which are now fragmented, giving different directions, will converge, and they will all include the word registered valuer, registered under Institute of Valuers. When this is going to happen, then the whole the perspective of the valuation world is going to change. So we are just hoping that when things get framed, structured, organized, then probably there will be a sudden boom in this valuation world. And then we all understand the product history of any particular product which is there in the growth stage, maturity. So friends, this is a good time to enter into this world. And believe me, in last 2 years, since I have become a registered valuer, before that I was doing some bit of valuation, but because it was not recognized. But since last 2 years, when it has been recognized, it is altogether a different perspective which I have got. And today, if you see what I'm doing in terms of times which I'm spending, so my most of the time is going under two worlds, that is insolvency and valuation. That is the area which I'm focusing on. If I'm working about 8 to 9 hours a day, so 8 hours is being spent on valuation and insolvency, friends. So that is how changes have taken place. So with that positive outlook, let us go through the valuation methodologies, friends. So we have three methods for valuation approaches. The three methods are, if I put it into proper simple words, which we all can understand, is MIC approach, the market, income, and the cost approach. Though the other words could be relative valuation, the discounted cash flow, and the asset-based valuation. So friends, in all the valuation standards, be it the ICI valuation standard or be it the international valuation standard, I think both the valuation standards refer to these valuation methodologies, the market, income, and the cost approach. So let us all go through all three approaches and understand the complexities, the advantages and disadvantages of these methods. So relative valuation, friends, we all understand what is relative valuation, because the term itself says that we have to compare our company. When I say our company, that is a target company. So when we want to value the target company, probably then we have to compare the other companies. Other companies in terms of what is their enterprise value in comparison to the sales, enterprise value with regard to the EBITDA margin, the P ratio, the price to book ratio, or there can be so many other parameters. So relative valuation is nothing but what we do, we compare the target company which we are trying to value with all the other comparable companies. That is the relative valuation. The second valuation approach is more technical, more complex, and a lot of maths are involved, a lot of forecasting, data crunching, research is required, and that is known as the discounted cash flow valuation, which worldwide is now more of an accepted method when it comes to companies which are non-listed. And worldwide, if you see, if there are 100 companies existing in the world, you'll find that 80% of the companies are non-listed. So discounted cash flow valuation is most of the companies are valued based on the DCF valuation, friends. And the last one, the asset-based valuation, which is very specific and probably which is not generally followed for a normal running company and operating company. That is the asset-based valuation. But still, there are situations where we need to follow that asset-based valuation, is the net asset method, the liquidation method, and the replacement method, where we try to value the company based on the actual realization of the value of the asset, friends. So these are the three main methods, and we have just discussed in brief the broad parameters of each of the methods. So let us take a deep dive in the whole world of these three methods. Starting with relative valuation. I think from my perspective as a registered valuer, I believe this is the best method, and I would always appreciate that if a valuer given an option between these three methods, we should always prefer this method. Why? I'll tell you the reason why we need to follow the relative valuation. So to do relative valuation, what we need to do is to identify comparable assets and obtain the market value of those assets. So the first step is to find out all the comparable firms, companies, which are similar to what we are trying to value. And then we want to create those standardized value. So the standardization could be done on a lot of parameters. And then what we do, compare that standardized value with the target company and apply that standardized value for that particular target company, adjusting for any kind of difference that may be related to the size of the company or any other parameter. So what could be the ways? So let us understand the specific ways so that things become more clearer. Now, if you see the relative valuation, I think the listed companies are, they are based on this relative valuation. All the companies which are listed, probably you will find that a company like Ultratech may be valued based on ACC or Ambuja Cement. So because they are on the same domain, and the adjustment could be done because of the size factor. So in a lot of cases in the stock market, you will find that the research report which comes out in the market by all the brokers, the equity research companies, you'll find that they are taking the relative valuation for the purpose of the valuing all those listed entities. And when it comes to merger and acquisition, I think worldwide we all understand that merger and acquisition is one of the more bigger chunk of business for all the professionals. And most of the transactions under merger and acquisition happen on relative valuation. So in the market, when you go in the market, probably relative valuation is an accepted phenomenon. Maybe DCF may not be an accepted phenomenon. So what are the various variations on these relative valuation, the various criteria, the parameters? So there could be based on earnings, it could be based on book value, it could be based on revenue, or it could be based on very sector specific. Now, for example, let's say if you want to find out the value of a cement company, maybe the cement companies are valued based on the per ton capacity, not based on the revenue part, the earning part, but we are purely based on what is their capacity. So let's say if Ultratech has got a capacity of 1 lakh ton, and the market gives a multiple of 200 rupees in terms of value per ton. So 1 lakh multiplied by 200 is the worth of that particular cement company. So a very simple example, which is very sector specific. So friends, there are a lot of variations on these relative valuation. It all depends on the nature of business, industry, and accordingly the scaling variable could be taken. Then again, a base year multiple has to be identified. Now, what is a base year multiple? See, whatever variable which we are trying to take into consideration or the factor, we need to understand that this factor, this multiple, what I told you example as a for cement company, it is 200 rupees per ton. Now that 200 is based on what? Is it based on the most recent financial year, or it is based on last 4 quarters? It is based on large average of last 2 years, 3 years, or it is based on the future forecasted. So friends, that base year pattern, the base year criteria to be fixed, which is very important. And again, it will depend upon the nature of business and what could be the possible base year. So friends, 2 important things to be understood is what could be the scaling variable on which we do a relative valuation, and the base year. Now, there are 2 words which is very important, friends, to be understood. Very important from exam perspective, as always, in terms of understanding the world of valuation, is the enterprise value and the equity value. So there is the two different word which comes in is the equity value and the enterprise value. So enterprise value in general will include the value of equity plus value of debt in common parlance. So enterprise value includes the value of equity plus the value of debt. So if you want to ignore the capital structure of a company and we need not to value the company as a whole, then enterprise value is the more important criteria of judging the whole value, because capital structure may differ from company to company and it all depends upon their individual capability. So therefore, the market believes that the enterprise value is a better way of understanding the company's worth. Maybe somebody for a company like, let's say, the IT companies, maybe the enterprise value may not make a difference because most of the IT companies are debt free. So in that case, it may not have that much significance. So in that case, it will be the equity value which is much more relevant. So 2 concepts, equity value and the enterprise value, very important, and is a regular question asked in the exam. Probably there will be a separate lecture also where we will try to understand how to calculate the equity value and the enterprise value. Okay, so how do we go about it in terms of valuation based on relative valuation? We have already understood the basic criteria and the process part. So the steps are very clear. We identify the comparable universe. So maybe for a cement company, there could be 5 comparable company. For IT company, there could be 10. But maybe there are certain industries where you don't find the comparable. You don't have enough comparable. So you need to identify all the comparable universe in the Indian context, and if possible in the international market also. Maybe the international market context may not be that much relevant, but yes, it gives us an idea of what is happening worldwide. And because the geographical factors, the economic factors of the other country are different with respect to the Indian market, but still you have a fair you have a fair sound knowledge of the whole business spread across the world, and you do get some idea that how the valuations are done across internationally also. Then we need to come at the standard variable, which we try to create the standard multiple, that may be the sales, the EBITDA, the PAT part, and then you standardize that multiple and apply it with the target company. So that is the basic process. Now, friends, very important. Why did I say that? This valuation approach is most accepted, most favored by the valuers, and especially if I seek my opinion. The reason is, uh, valuation based on relative valuation is done not on my criteria, and this is a criteria where market has accepted it. So from my perspective as a valuer, what I'm just trying to do is just trying to copy paste the market perception. I'm not trying to create my own perception. So that gives me certain kind of cushion in terms of valuation methodology, which I'm trying to adopt. Because if somebody wants to question me that how did you value this company, so I would say that I have not valued this company. The market has valued this company. What I've done is just applied that particular market valuation method to this company. That is the logic, and therefore to that particular extent, I would be safe enough. Yes, no fault in my valuation technique, because that is how the market perceives it. So that is why I always believe that relative valuation or the market valuation is one of the safest ways of valuing the company. But as I said, it applies only majorly to the listed companies. So applying it across the board may be difficult, because identifying the comparable firms of similar nature, size is always difficult. So that is why the choosing the comparable firms is a very essential part of the whole. We need to find out that whole domain. So the first step is choosing the and only you can go further in identifying those comparable for companies which are available in the listed space. Then the different relative valuation criteria. The first is the EV to sales. So that is the first and the most simplest criteria for doing the relative valuation. EV, as I mentioned, that is referred to as enterprise value. EV is nothing but enterprise value to sales. Where this method is used, it can be used for loss-making and troubled companies, because if we go by profitability, probably the loss-making and troubled companies may not be having that particular profit, and therefore valuation cannot be done on the basis of profit. Therefore, you'll find that companies which are incurring losses, companies which don't have much of profitability, lower margin, then this relative valuation of EV to sales should not be used. Then again, very important, friends, they are subject to less impact of the accounting policies, which we all understand. Being chartered accountant, company secretaries and professionals, we all know that if we go further down the, below the line, that is profit and loss figures, the detailed balance sheet, you'll find that all those items in the balance sheet and P&L are subject to a lot of accounting policies. But when you see enterprise value to sales, there's only one accounting policy which relates to revenue recognition. Apart from that, there's no other factor which will contribute to the adoption of specific method for a particular accounting term, that is sales. So friends, enterprise value to sales is not subject to so much of accounting factors. Therefore, it is again one of the most widely accepted technique. It eliminates the impact of financial leverage, because as I said, when we measure enterprise value, we ignore the impact of debt in the whole capital structure, and it is assumed that the business is dependent upon the amount of funds deployed rather than from where the funds are deployed. So enterprise value will ignore those financial leverage factors. And enterprise to value to sales multiple are not as volatile as P multiples, as we'll see in the next slide, that price earning multiples are subject to a lot of volatility because of the changes in the earning part. So because of less volatility, it's a standard multiple which is, which remains standardized over a period of time. Therefore, the enterprise value to sales multiple is one of the most common techniques of relative valuation. So across the industry, if you read newspapers, if you read research reports, if you watch CNBCs of the world, you'll find that they are mentioning that the enterprise value of the company, and they are trying to compare it with the sales part, and that is how the market, judges the price of the particular company. The next is enterprise value to EBITDA. So now we are going below the sales factor in the profit and loss. So moving from sales, we are going to the earning before interest and tax and depreciation and amortization. And this is more a reflection of the value of the company with respect to the profit part. So again, it is ignoring the impact of financial leverage, the debt part, because we are considering the interest before, we are considering the profit before interest. So one factor is considered in the same way as the enterprise value to sales. But again, they are impacted by accounting policies, maybe except for the depreciation part, because here the EBITDA is taken. P&L may be subject of accounting policies. So the whole value may change based on the accounting policy adopted by the company, friends. So enterprise value to EBITDA again is one of the important factors to be considered. Now, where is it used? Obviously, when there's negative EBITDA, we cannot use it. So a lot of industries where manufacturing is there, the major focus is on the EBITDA margin, and we'll see that a lot of manufacturing companies in the listed space, in the stock market, and when there is a consistent profit delivered by the company over a period of time, then the enterprise value to EBITDA margins are used. The third is price to earning ratio, friends. I think it is one of the most widely used technique in the stock market, where the market price is based on the price to earning ratio, where more consideration is given to the earnings part. But as we have mentioned, that earnings are subject to a lot of volatility because of the adoption of different accounting policies. So we need to be very cautious. And when we try to compare, see, relative valuation, as we all know now, that we compare and then apply it. We standardize it and apply it to our target company. So we need to be very cautious that how that earnings are calculated of the comparable company, and if there is any deviation from our accounting policy to the accounting policy of the comparable firm, and we need to make the adjustment. So very important, price earning ratio cannot be as standalone, could be adopted as such as copy paste. We need to make certain variations in that particular price to earning multiple, and then apply it to our own target company. We cannot apply it when the earnings are negative. And so one example could be, can we apply it to startup companies? The answer is no. Can we apply it to companies which are just started? The answer is no. Can we apply it to companies which are heavy capital intensive but low on profits? I would say no. Price to earning ratio is very specific, but generally, if you go in the market and want to find out what would be the possible price of a company, then as a layman, I think this is one of the most common methods to calculate the worth of the company. Then the last of the common techniques, what we are just discussing is common technique, friends. As we have mentioned, that there could be very sector specific relative valuation technique also. So what we are discussing is very common technique, is price to book value. Normally, where do we use this price to book value? It is used in financial service sector. Financial service sector like banking, NBFCs, insurance companies. So these are the industry which are based on this price to book value. Again, subject to a lot of accounting policies and methods. And normally we see that the financial service sectors are subject to a lot of regulations, and we assume that all those companies will follow a standard way of bookkeeping or accounting in terms of the RBI guidelines or IRDA guidelines. Therefore, price to book value could be considered in those industry. But if you want to apply price to book value for a FMCG company, for a manufacturing company, then you may find it very difficult, because again, the book value is subject to a lot of things. So therefore, it is applies only to the financial services sector. So that is again one of the common methods adopted by the market. So we have gone through 4 methods. Now, a normal question which comes into the mind, friends, and it should come, and somebody should raise out that question is, yeah, anybody? So if you are reading the newspapers and you are aware of what is happening in the economy, and you will find that Byju's is being valued at 1 billion. You'll find that ClearTax, a company which is of same business, is valued at this much price. You find that how Flipkart is valued at such much price. So what happens in case of startups? So do they follow the enterprise value to sales? Do they follow the enterprise value to EBITDA? Do they follow this criteria? So the answer is, friends, I would not say that they would not be following these relative valuation. They could follow, but in all these companies like startups or other kind of companies which have just entered into the world of entrepreneurship, the variable could be different. So there the valuation is done enterprise value based on the gross value of goods sold, that is GMV, gross merchandise value, not based on the value of the goods, but the gross merchandise value, not based on the profit, but the gross merchandise value. Then they could be based on the number of downloads of the applications which they are trying to create. So it will be based on the number of apps. It could be based on the number of users. So friends, today relative valuation has altogether taken a different shape because of the springing up of so many new type of companies where they are not considering the sales or the profitability as one of the measurement of value. So they think that the value of the measurement could be the number of people who are trying to watch the screen, number of people who are trying to play the game. So that is their criteria of valuing. And these are all concepts which have been developed by the valuation professionals across the world. Never, the companies never came forward and mentioned this, but these are all the techniques and the research which has been done by the valuation professionals. And today, if you see the new kind of companies, the AI companies, the IoT companies, they are all based, the valuation is based on a lot of new type of relative valuation criteria. So friends, this is again a progressive method, and again a dynamic method. I would not say that it has now become stabilized, because as the industry nature, new type of industries are coming in, we will find a lot of new relative valuation concepts. So issues to be considered under relative valuation is the nature of business, the normalized result, because if you do a relative valuation based on the current scenario, I would say it should not be accepted, because the current scenario is not a normal year. So it is always better to have a normalized result. So maybe a 3-year average could be taken for a normalized result to find out the relative valuation criteria. Then very important, friends, surplus and non-operating asset. That is always one of the major consideration in valuation. When you enter the world of valuation and when you actually do the case studies, you'll find that surplus and non-operating assets within a company plays a very important criteria. And in relative valuation, probably it is not considered directly. So therefore, this is again one of the important factors. Let's say, for example, a company like Infosys, Wipro, where they have so much of huge surplus lying in their books of their account, and all these monies are invested in mutual funds or any other place. Now, will they be a part of the relative valuation? So we need to consider these issues. Then transaction data, it is a backward looking, because relative valuation is based on, let's say, the current scenario or a scenario based on, let's say, 1 year, 2 years back. But when we are trying to value the company, the valuation is done based on the future, because your investment today is based on the future outlook, because you're investing today. So transaction data, we need to look at whether how much backward looking it is, and it can be out of date at times. Applying the concept of averages, as I mentioned, that normalization will bring in the concept of average, and therefore we need to standardize the values based on the average or the other statistical concept. And if we're trying to compare a relative valuation with companies based outside India, then we need to consider the differences in the accounting policies because of the IFRS, the accounting standards, and so on. So these are the normal issues which are considered for relative valuation. If you have any questions, you can please keep on asking.
Sir, this is Sivakumar here. Just,
Yeah.
Two questions I have. One is,
yeah,
when we are talking about this various methodologies, a lot of these are not applicable to, say, a new age company, a startup, or where the valuation discovery is not still happening. So
correct.
In such cases, do we really only follow the DCF method? That is one question that I have. And the second question is, when we do this comparables, EV, EBITDA, EV sales, etc., do we also assign any risk weightage to the fundamentals of the company? I mean, it's good to have a comparable and then assign to a particular business, but if that business itself has some inherent risks involved, which is internal to it, do we also do that? Consider that.
Okay, so with regard to the second question, when we evaluate the companies, the risk factor, when you follow DCF method, then the risk factor is naturally taken. So that is incorporated in the whole valuation method itself. But if you apply a relative valuation, directly understanding that, we have incorporated risk in the relative valuation, probably it is not visible. But when you do a relative valuation, the market is market has accepted that phenomenon. So when that market has accepted that particular factor, so whenever market values, probably it takes into consideration all the risk factors of that business. So it may not be visible in terms of any specific parameter that, in enterprise value to EBITDA, a risk factor is a part of EBITDA. You cannot say that. So it is not seen, but in DCF, the risk factor is directly seen. That is the answer to your second question. Now, with regard to the first question, when you say that the new startup companies, whether they are based on relative valuation or the DCF method, if you go by the news readings, the information, you'll find that it is they're trying to adopt the relative valuation for agreeing on a particular terms and condition. If you are trying to buy out, let's say Amazon is trying to buy out Flipkart. Now, on what criteria they will buy it? Will they go for the DCF method and find out the future cash flows and find out what is the worth of the business? Probably no. In that case, they might try to adopt a relative valuation of Flipkart based on the value of transactions done on their website or through the app, and that is how they arrive at the value. But when you want to give a registered value report, maybe in that case, what may happen that you may follow a DCF approach for valuing that company, because you may not find sufficient data available for that startup company to go for comparison. So in that case, it is very difficult. You may think that this company is comparable to that company, but that data is not easily available. So you get an idea that the relative valuation criteria is A, but you cannot adopt it because information is not there, sufficient information is not there. Therefore, I would go for a DCF method. That happens in a startup company.
Thank you.
Yeah. So let me throw some examples. I think very simple examples on the screen, which will highlight the importance of the relative valuation. Let's say we have a company, ABC company. The next year forecasted EPS is 1.5, and we have a comparable company, XYZ Corporation, where the next year forecasted EPS is 0.80 and the current share price is 20. Somebody's mic is open. Yes. Okay. Thank you. Okay, so we have this comparable company where we have calculated the PE ratio, and the PE ratio comes to 25. So a simple relative valuation concept says that multiply the P ratio with the EPS of my company, that is ABC. So 25 into 1.50, that is 37.5 is the implied market price or the theoretical price of ABC company. So this is based on what? The forecasted EPS. So it is a forward looking rather than backward looking. And the comparison is done only with apples. That is the biggest tough thing to understand, and very difficult to find out two similar apples in the market, because we all understand that every company has its own characteristic. Another example of enterprise value to EBITDA. Again, very simple concept. So ABC company next year forecasted EBITDA is 50 million, and number of shares outstanding is 20, and the value of debt is 50 million with cash, no cash in hand. Then they will have a comparable company where the next year forecasted EBITDA is given as 40 million. Current share price is 20 rupees. Number of shares outstanding is 10 million. Value of debt is 100 million. So what we do, we calculate the enterprise value. As I mentioned, enterprise value is nothing but value of equity plus value of debt. And if you are able to see, we have calculated first the value of equity. That is 20 into 10. That is 200 plus the value of debt is given as 100. And minus the amount of cash, if any, which is not there. So 300 million is the enterprise value, and 300 divided by the EBITDA ratio, EBITDA of the company XYZ 40. So my multiple comes to 7.5, and we apply this multiple to ABC company. So the value, enterprise value would come to 50 million into 7.5 is 375 million. And if you want to find out the value of equity, it is very simple. You subtract the amount of debt from the enterprise value, 375 minus 50, to get the value of equity, that is 325. And when we divide the equity value by number of shares, we get the price per share, that is 16.25. So any doubts on this calculation part? I think very simple. No?
I have only one question here. When we do this, do we also consider what is the cash available on date, or that's not?
Yeah, we do consider. As I mentioned, that we surplus asset, non-operating asset has to be included. So here in the enterprise value, the formula is the value of equity plus value of debt minus the value minus the amount of cash.
Okay.
Naveen sir, I have a question.
Haji, please.
So we take all these values as on the date, as on the cutoff date of the valuation, right?
Correct.
Yeah.
So that was the first method, relative valuation. Now we move on to the second method. That is the DCF method. So very important, friends. The DCF method is one of the most important criteria of valuing any company, and this involves a lot of complications and research and data crunching from our end. So the simple words, simple concept, if somebody asks you what is DCF method, friends, you just need to tell DCF is nothing but present value of future free cash flows. So this term, which should be, in your mind always when it is when you talk about valuation, the free cash flows. And we have to discount that. When we talk of present value, it has to be discounted, and that discounting is done by a risk-adjusted rate. So as Mr. Siva mentioned that how this risk is taken into factor. So here comes the risk factor. So we discount it by a risk-adjusted rate. So now what is the main thing, friends, here? That the main thing is we need to calculate the future earnings, and it is assumed that the company is a going concern, which is again a very essential part. It incorporates the impact of financial leverage, the gearing part, the interest and non-interest factors. It can be used for all type of companies, be it asset heavy or non-asset heavy, because we are concentrating more on the earnings part rather than the asset part. And it can be applied to companies with negative net worth, and at times maybe with negative earnings. But if that negative earnings is for a continuous period of time, then DCF may not apply. But if it is only for, let's say, 1 year, 2 years, then we can apply the DCF method. And very important, it incorporates the risk factor of that particular business also. So friends, that is why, because of all these advantages or the parameters which are included in DCF, it has become one of the most widely accepted techniques of valuation. And just on the other aspect of professional opportunity, and just on the lighter part, see, if somebody wants to give you a fees, and why would he give you fees that if you are adopting a relative valuation? What we are trying to do in a relative valuation is just trying to copy the market method, applying a standard line that because Reliance is valued at this particular multiple, that is why a company similar to Reliance would be valued at this particular multiple. So you're writing in your valuation report a too simple line. But and if for that particular too simple line, somebody is paying you 25,000, 50,000, 1 lakh rupees, why? But when you are following a DCF approach, the person who is paying you that money would appreciate that at least you have done some homework, you've done some research, you have done some mathematical calculation, which he may not be able to understand as a founder, as the promoter, as the business owner, but he will appreciate at least you have done some work. So from his perspective, paying a fees because of DCF would justify, but paying a fees for relative valuation, why would anybody try to pay that amount? So that is a different perspective, friends. So DCF valuation will call for certain kind of effort from the valuer's angle and to derive a particular value. So why DCF valuation? Friends, important exam slide. Why do we need to follow DCF valuation? Because it gives a more approximation to the intrinsic worth of the business. That is one important thing. Relative valuation, as I mentioned, they are very simple. And as I just give you the example that why would anybody pay you for such a simple approach? So therefore, it is much simple. And DCF relies on free cash flow, which is basically an actual measurement of the business. That if you want to find out a business worth, we need to derive that what is my free cash flow which is being generated out of that business. It was assumed, it is perceived, it is accepted that it is a better measure of a settlement of the true value. So from my perspective, I think the more concrete reasons could be it is a risk-adjusted measurement of the future earnings. And today, whenever we are trying to invest, we are investing for the future. We're not investing for the past. So therefore, DCF incorporates that future factors. So what are the inputs required for DCF calculation? So the inputs required are multifold. Though the slide is saying only 3 factors, but when you go into details, you'll find that there are multiple things which have to be taken into consideration. So the first factor which is required is to project the cash flows, generally from 4 to 6 years. So there is an estimation of the cash flows for 4 to 6 years. That is the cash flow, not the profit and loss or the balance sheet part, but the cash flows. And that too, cash flow having specific terms. Very important, friends. These 2 terms will now be a normal part of your valuation profession. Whenever you are entering this world, these 2 words, FCFF and FCFE. Please again put it in your permanent memory. Very important. It should be part of your permanent memory, and download these 2 words from all your Play stores, and please keep it stored in your mobile phones and in memory. FCFF and FCFE. FCFF is a free cash flow firm where it ignores the capital structure. In common parlance, as I said, there will be a separate session on FCFF and FCFE and the relationship between those 2 and the calculation part. I'm just trying to touch upon the brief periphery of the FCFF and FCFE. So FCFF will give you enterprise value. FCFF will give you enterprise value. FCFE will give you equity value. That is the one major difference. FCFF will give you enterprise value, and FCFE will give you equity value. And enterprise value, as we know, that it will include the value of debt. Therefore, it ignores the capital structure. Okay, so then the next factor is the discount rate. That is the cost of capital in case of FCFF and cost of equity in case of FCFE. So when we discount it, when we use FCFF, we have to use WACC, that is weighted average cost of capital. And when we use FCFE, we need to use cost of equity. And then the terminal growth rate, which is very important because we are projecting a cash flow for 4 to 6 years. What will happen after that, after 6 years? So what would be the worth? Whether that worth after 6 years has to be incorporated in my valuation or not. So answer is yes, we need to incorporate that. And for that, we need to calculate the terminal value part. So these are the major parameters or the constituents or the components of the DCF part. So let us now again further break all these projected cash flows, the discount rate calculation, the terminal growth rate calculation into different formulas and understand the formula and I understand the whole DCF method. So value of business, please note down this formula, very important. Value of business. Present value of free cash flow for growth period. Present value of free cash flow for growth period or explicit period. Plus present value of terminal value. Plus present value of terminal value. Plus present value of terminal value. So
sir.
Yeah.
Sir, you have mentioned value of business. Does it
Value
not
of?
include the? Is it
Yeah.
audible, sir? Value of
Yeah,
business.
Yeah. Value of business, yes.
Yeah. Does it not include the capital structure that is debt also in this?
Yeah, as I mentioned that I've used FCFF. So when we are using FCFF, we are trying to derive the value of business. That is the enterprise value.
Okay. Okay. Thank you.
Okay, so now we'll understand each term, friends. And very important, if these concepts are very clear, then the next 6 days, 7 days will be very easy for you in terms of understanding the concept, the term part. So when I forecast the future cash flows for 4 to 6 years, this 4 to 6 years are termed as growth period or explicit period. Growth period or explicit period. Remember, the next 4 to 6 years are termed as growth period or explicit period. Normally, see what happens very rationally when you are trying to value a company today. Why they are trying to value a company? Because the company might be trying to raise more funds. So when the company is trying to raise more funds, it will be expected that the funds will be used for expansion. And when the company is for expansion, there will be a sudden growth of that particular business. And for that, what we are trying to do is to value the company based on that growth. See, one, future cash flows will be dependent upon the past, whatever the companies have been earning so far. And that earning is because of their existing asset. Remember, there will be two types of asset: existing asset and growth asset. Existing asset and growth asset. Existing asset are those assets which the company is already having. So my future earnings will be based on the existing asset. But my future earnings will always also be based on my growth assets, which I will be investing in due course of time in future, which if we club all those existing and the future, will give me the earnings for the growth period or the explicit. And for that, I can estimate that a reasonable period of 5 years is good enough time period to estimate or to predict my growth period. So when I estimate those 5 years projected cash flow, for some business, it may be 7 years, 8 years, 10 years. For some, it may be 3. For let's say in a case of a startup, which is a new business, they might not be able to predict the future beyond 3 years. So for them, the growth period may be 3 years. So growth period generally ranges from 3 to 7 years. That is a normal range. So what after 6 years, what after 5 years, what after 7 years? That particular time period is known as stable period. that particular time period is known as a stable period, under which we will assume that the business will continue to grow at a particular standard rate over a period of time till infinity. Over a period of time till infinity, because we are assuming a business is a going concern. Very important. Very important. This is the base of DCF method. So again, repeating, friends, which are the two periods? Can anybody tell me the two periods?
Growth period.
Growth period and
Second one is
Stable.
stable period.
stable period. Correct, friends. Always remember, whenever a question will come in exam or for practice, or if any faculty will come, they will always mention these two terms: growth or explicit period and the stable period. Now, the present value is calculated for the growth period, and for stable period, we calculate another value known as terminal value. Stable period, we calculate another value which is known as the terminal value. So what is terminal value? For example, I've estimated a growth period of 5 years. So I calculate the cash flows for 5 years and I calculate the present value for 5 years. Now what after 5 years? So what I do from 6th year onwards till infinity, from 6th year onwards till infinity, for that particular period, I calculate a value known as terminal value, which is the value of business after 5 years, which is the value of business after 5 years, which will include all the future benefits after 5 years till infinity. So what is terminal value? Terminal value is the value of business at the end of growth period. Remember, if somebody asks you what is terminal value is the value of business at the end of growth period. And what will start after growth period, friends?
Stable period.
Stable period. So basically, terminal value is nothing but the value of the company of the stable period.
Correct.
Value of the company for the stable period.
Right.
Right? Now,
Yes, yes.
whatever value which we are calculating for future, remember, these are values for future, but we are doing the valuation today. When? Today. So when you are doing the valuation today and you have all the values for the future, what do we need to do? We need to calculate present value. We need to calculate the present value. So therefore, you will see in my formula, there is a term PV, present value of cash flows for the growth period, present value of terminal value. Because whatever we have estimated is for the future and we are calculating the value of the business as on today, therefore it is known as present value. Any questions?
Sir, basically determination of cash flow comes in the forte of the valuer, or the management will be supplying the cash flow information?
Yes, a very valid question. See, do you think as a valuer, can I estimate the cash flows for Flipkart?
Very difficult.
No. So that means the cash flows have to be given by whom?
Management.
Management. So they will give you the cash flows. As a valuer's job, what we can do is just to take a justification that whether those cash flows are justifiable or not. Now, how do we take that justification or understand that justification? So there will be certain past data of the company. So based on the past data, we can always determine the trend, whether the trend is increasing, and in going forward, if that trend, they are taking that trend as the same trend, or they are making some adjustment to the trend. So whether that trend is justifiable or not, that is our job. That we need to understand whether that trend is justifiable or not. So we need to question on that particular data, find out a proper justification, and we accept that particular management representation in terms of projection.
But how do we come to know about whether we are approached for valuation at the time of stable period or at the time of a growth period.
Okay, no, that is very simple. I think today, if you're trying to do a valuation of any company, now we are standing today, and from today onwards, the growth and the stable period will start going forward. So if the company comes to you for valuation, let's say they ask you to do the value of the company as of today, what you will ask for the management, that please give me a forecasting for the next 5 years. And then based on that, you give me an estimate of the stable growth rate which you are expecting over a period of time till the business continues. But that's it. So once you have that future cash flows in front of you, the terminal value calculation can be done by adopting a formula. So we don't need to, find out any data of terminal value. We just want the 5 years cash flows. That will give you the base for calculation of terminal value.
Yeah, that's sure. Like, for example, if I take an example of a telecom company.
Yeah.
Telecom company, when it began in 1995, 96.
Yeah.
So for the first 15, 20 years, they were in a growth phase.
Yeah.
Now, if I look into the previous data of the telecom company,
yeah,
that they were in growth phase, and assuming the previous data, the management gives me the same rosy picture for the next 15 years. But I don't think so that 15 years, coming 15 years would be a rosy picture for the telecom company. They are already in a stable growth stage now.
Correct.
So they won't able to grow further as they grew in the past 15 years.
Correct. Your question is absolutely bang on. That for a company, for an industry like telecom, the current scenario says that they are undergoing a stable period, right? So for a valuer, whether the stable period is a growth period or a stable period. Am I right? Is that the question?
Yeah.
Now, when I say there's a growth period, for me, growth period does not necessarily always mean that there is a possibility of 15-20% growth. So for me, growth period means if there is a marginal increase from the previous year cash flows, that could also be termed as a growth period. So for a telecom industry, the growth may not be 15%, but the growth may be 2 to 3%. So for me, estimating a growth period does not necessarily mean that there has to be a particular growth. From my perspective, growth period will be in terms of time, 5 years. So there may be increase in cash flow, there may be decrease in cash flow. There is both sides, not necessarily always an increased part, right? So from my perspective, growth period means next 5 years. So what I'm trying to get from the management is the next 5 years cash flow, whether they are on the higher side or on the lower side. But in common parlance, we term it as a growth period. That is the only way. So we do not say it is a declining period.
Correct.
Because nobody would like to say that their company is a declining stage. So it is why in common parlance, it is termed as a growth period, because it is assumed that in a going concern, there will always be certain kind of growth. Even in our profession, if we see, though the profession might have reached certain kind of maturity in some areas, but still we are very hopeful that we will be able to grow in next 5 years. So that is why it is in normal common parlance, we term it as growth period. The growth period may have stable cash flows.
All right, thank you.
Yeah. Okay, so after understanding the basic formula, now let us understand each concept in detail. Each concept in detail means understanding what is FCFF, understanding how to calculate the present value, understanding how to calculate the terminal value. So the first concept which comes in, if we go by the formula, is the first word, present value. PV, present value. Because we have understood what is the growth period, which is generally 4 to 6 years. We have understood terminal value. So what we are trying to understand the various mathematical things is, first thing is cost of capital. Present value. For present value, sorry, not the cost of capital. For present value, we need a discounting rate. For present value, we need a discounting rate, right? So that we all know. Now that discounting rate is two. There are two discounting rates. Remember, friends, there are two discounting rates. What are the two discounting rates? KO and KE. KO and KE. KO means cost of capital, and KE means cost of equity. Cost of capital and cost of equity. Now, when to use cost of capital, when to use KE, a simple relationship matrix table which you can create. When I'm using FCFF, we use KO. When I'm using FCFF, we use KO. When we are using FCFE, we use KE. That's it. FCFF, KO, FCFE, KE. So what is the formula for KO? Very important, friends. Formula which we have studied in our CA intermediate and final exams. But again, just trying to recall all those things. If you have forgotten all those number crunching formulas for your exam days, is the KO is equal to weights into cost of equity, weights into cost of debt, plus weights into cost of preference shares. A small change which I'm going to make in the formula. Weights into cost of equity, weights into cost of debt, which is after tax, and weights into cost of preference share. Very important, friend. Weights are based on market value. Remember, exam question. Weights are based on market value. Next time a faculty asks you, weights are based on what? Please do answer it correctly, because they'll always question what Naveen sir told you. You're not able to remember. That means the fault is in me. So remember, weights are based on market value always. Now, the question is, why market value? See, friends, remember, valuation is done today. So we need to consider the current factors for calculation, for valuation. The company might be having their equity capital 20 years back, equity capital. The debt may be 5-year-old. But when we are trying to value the company today, we have to take into consideration all the market factors as of today. So therefore, the current market value of equity, the current market value of debt has to be considered. So therefore, the weights are based on market value.
I have one question.
Yes.
When we are saying, market value of equity, okay, that one can easily ascribe, or rather, it's more or less universal sort of thing for particular specific thing. But for debt, suppose the market value of debt is it could be relative. One company will be able to raise funds at a lower rate or much higher than the market rate.
Yes.
So if they demonstrate to us, that their cost of capital is lower than the market, can we go by what they say?
So your main question, what I'm trying to understand, is that how do we calculate the market value of debt?
I'm saying cost of debt is available. So, okay, and then the market.
So there's some disturbance in your voice, please. Can you?
Yeah. Okay. Can you hear me? Can you hear me now?
Yes. Now it's clear. Yes.
Yeah. Suppose the market value, the market rate of borrowing is say 10%. I'm just for hypothetical. I mean, just a example.
Okay.
But the company is able to demonstrate to me that their debt is only at 5%, or due to whatever foreign currency debt and whatever they are able to hedge and do it.
Right.
So we still take a lower than the market rate.
Yes. Why not? Because it is a company. We are trying to value this company, and this company has got a different benefit structure. So we should consider the 5% rather than 10% for calculation of the cost of capital.
But as per this thing, the weights are still to be measured as based on the market. I mean, as per the theoretical part of it.
Yes. So my logic is that if this company is able to raise at 5%, probably why would any lender give this company a particular rate of 5%? Because companies of such similar nature in the market can avail loan at 5%. That is why the lender is giving it 5%. Understand, if a 5% is the rate of interest on a particular borrower, probably because the market has accepted that 5% as a rate to this particular borrower of this particular credit rating. See, all these rates are based on the credit rating, we all understand. So based on the rating of the company, rate is 5%. So that rating is generally applied to every class of company. It is not specific that, because this is the company, that is why 5%. There might be certain variation, 5% and 5.25. But in general, all rate of interest is dependent upon the rating of that company. And if any other company which falls under the same category, probably they will be also able to raise the company funds at 5%. That is also a possibility. So you cannot say that 5% is very specific to the company. 5% belongs to a particular credit rating criteria. That is why the rate is 5%. So in fact, 5% is a market rate, not a company specific rate.
No, why I'm asking this is a financially healthy company is able to raise at better rates. That's where that's
Agreed. That's what I'm saying, sir. If a financial healthy company is able to raise at 5%, a similar financial healthy company would also be able to raise at 5%. Why would anybody differentiate two companies of same nature, same industry, same financial health, and somebody is able to raise at 5% and somebody is able to raise at 10%? It is not possible. So if both companies are at the same level, they both will be able to raise at 5%. So that means 5% is a common rate for those class of company falling into that category. So in fact, 5%, though it may be company specific, but then that is a general market accepted rate. Now, that is one way of understanding the market rate. The second the second thing which you need to remember, friends, when I talk of market rate, it means that this company which you are mentioning, Mr. Siva, might have been able to raise this rate, my loan, let's say 2 years back. But today, if the same company goes in the market by wanting to raise same kind of funds, and if today the market rate may be 4%, maybe 7%, because the scenario has changed. So if we are calculating the weights today, because we are valuing the company today, we will not take 5%, we will take either 4% or 7%. That is the meaning of market value. You got my point?
okay. That means, yeah, I'm getting it. That means essentially, if you're convinced about a particular rate for a company and they're able to demonstrate that this is a present rate, that can be ascribed as the market for that universal companies. Can we say that?
Correct. That is one way of understanding. That applies to universal same class of companies. The second, what I'm trying to forward my point is that when I say the market rates means the current prevailing rate on that particular company. So the rating might have been same for the company, but when it goes to the market today, they might be able to raise funds at 4% also, because the current prevailing rate of interest has decreased in the market.
Sure.
So for calculation of the cost of capital, we will not take 5%, we'll take 4%. Even though in the books of the accounts, the rate of interest is mentioning as 5%.
Okay. Okay. Thank you.
So friend,
I have a question.
Yes.
One is related to this debt itself. It's a little complicated, like when Mr. Shiva was asking. I felt that there's more complications. Like if the debt is in the books at 5%,
yes,
and the company is able to demonstrate that this was a historical rate, but
correct.
if I go to the capital market today, I'll be able to raise at 4%.
Correct.
Then what happens is this W3, the weightage that is there,
yes,
at 4%, the same debt will be like, it will be more than par value, right? Like,
correct. Absolutely perfect, Mr.
So
Shuk.
that weight also goes up.
Yeah.
So KD minus 1 into 1.2 goes down.
Yeah.
Commensurately, the W3 goes up. So the entire cost of capital that pass through will be there.
Yeah. Agreed.
Yeah.
What your point is, logic is absolutely perfect. Now, because the cost of debt may be going down from 5 to 4, but because the rate of interest has gone up, the value of debt will increase. And what you are trying to mention is that it will be nullified, or the whole the cost calculation might change. So
Yeah,
answer is,
yeah.
so the answer is it not be nullified, but yes, the calculation would change, obviously. That is what
Yes,
we are
yes.
trying to look for. That what is the current cost of capital for this company?
Yeah, I had, I mean, that is clear. I had another question. Like
Yeah.
when we are valuing a private company, the whole purpose is to value the equity. So when you say that we need to ascribe the market value of equity, it becomes like a chicken and egg situation. We don't have the market value of equity. That's why he has engaged us to value the company, either through, I mean, you look at it as FCFF, and then you ascribe a value to equity. So I think, isn't it okay to go by book value of equity only to arrive at cost of capital?
Okay, so
Yeah.
let me tell you, the value which we take as an for the equity part, if it is a listed company, we assume it is listed company.
Yeah.
Then the value which is there in the market is not the value; it is a price. Remember, so cost of capital is based on the price of the equity share, and what we are trying to determine is the value. So there's a difference between price and value, which we had discussed earlier. That price may be market driven, but value, what we are trying to find out, is based on the worth of the business. So therefore, what your logic is that, when we have already taken the price and using that price, we are trying to calculate the another price, whether it's a chicken and egg. So that question is not there, because what we are trying to determine is something different. What we have taken in KO calculation is something different.
No, I'm saying in a case where the equity value was never discovered. That's why, like a private limited company or a limited company which is not listed.
Right.
So when that company comes to me,
yes,
the W1, I cannot determine the value of equity upfront.
yes.
So I need to take the book value as an approximation, get to KO, and then give him, and then discount the future cash flows and give him what is KE, what is the value of the
So in
company.
the case where the companies are not listed, then we don't have a choice but to go for book value.
Yeah.
Right. So that is perfectly okay.
Okay.
So, but my always thought is that when you go for cost of capital, the preferred is a market approach, the market value rates. But if that particular data is not available, then the obviously other choice is to go for the book value. Yes. Okay. So this is the formula, friends, for cost of capital. Now, for further calculation, that is for calculation of KD, KP, and K, we need to calculate some other technique. We need to go through the other formula. KD is very simple because the KD reflects the current prevailing rate of interest applying to that particular company. So that can be easily derived. But for K, there's another formula which we have to understand. So K is calculated based on CAPM formula. K is calculated on CAPM formula. That CAPM formula, very important, friends, known as capital asset pricing model. Capital asset pricing model. Very important capital asset pricing model. That formula is RF plus RM minus RF into beta. That formula is RF plus RM minus RF into beta. Now, what is RF? Remember, risk-free rate of return. Risk-free rate of return. RF is risk-free rate of return. Now, generally, from common understanding, what is the risk-free rate of return as of today?
Bank rate.
Security. Long-term government security.
Normally we take as government debt what they give return.
Government debt, okay. So
6% or 6.2, that's what risk-free rate of it.
Yes, Mr. Rajan,
6.5 or something like that, which is the government rate, which we anticipate today as risk-free return, because we still feel government is risk-free.
Okay. We still feel, as there's always a doubt, Mr. Rajan, right? Okay. So, friends, as you mentioned, that is correct. So now we take a 10-year or 10-year government security yield, or 20-year government security yield, or a 30-year government security yield. And normally these yields are calculated on zero coupon bonds, normally. So very important, remember from exam perspective, 10-year-old, or if you want to prolong it, take it for a further period. I think 20-year government securities zero coupon bond issued by the government would be an ideal measurement of a risk rating, ideal measurement, and that is what is normally done. So zero coupon bond, why? The answer is, why do we need to consider zero coupon bonds? Because again, some technical concepts are involved. Just to give you a simple one-line answer, because in a zero coupon bond, there is no intermediate interest cash flows, because zero coupon bonds are invested today and redeemed at a final date, and there's no intermediate cash flows, so there is no risk involved in between. So that is why the zero coupon bonds are considered for a risk-free rate. And if no zero coupon bonds are available, so whatever is the available instrument for a government security. Then the next term, very important, friends, RM minus RF. RM minus RF. Again, remember, RM minus RF refers to risk premium. RM minus RF refers to risk premium. RF is risk-free, RM minus RF is risk premium. So very logical, very logical. See, if you are investing in equity, you are taking some risk. So primarily, anybody would want certain minimum return, that is risk-free return. And because you are taking a risk, you will be desiring risk premium. So that risk premium is coming from the term RM minus RF, where RM refers to the market rate of return. Now, what is a market rate of return, friends? Market rate of return reflects the return from the Sensex Nifty over a 10 to 15-year period. RM is nothing, return on the market in terms of equity, because Sensex represents the best equity return in our country, or Nifty. So therefore, a 10 to 15-year period return on the market, on the Sensex, could be an ideal RM. And the third factor, which is very important, friends, where maximum questions are asked, is known as beta of the stock. Beta of the stock. And what does beta mean? So beta refers to there are two types of risk. Remember, friends, there are two types of risk in any investment, that is diversifiable and non-diversifiable. Remember, two types of risk, diversifiable and non-diversifiable. Beta represents non-diversifiable risk. Beta represents non-diversifiable risk. Very important, non-diversifiable risk. Beta represents systematic risk, another term. Exam questions, these are all exam questions. Beta represents systematic risk. Beta represents systematic risk. Beta represents non-controllable risk. Beta represents non-controllable risk. Beta represents non-controllable risk. These are the three terms: non-diversifiable, systematic, and non-controllable. In formula terms, no questions will be asked for calculation of beta in exam, but in formula terms, it represents the covariance of the asset with the market divided by variance of market. So it's a statistical formula. Covariance divided by variance. Covariance divided by variance. Now, in simple words, beta reflects the relationship of the stock with the market. Simple words, beta represents the relationship of the stock with the market. What does market means? Market for us means Sensex and Nifty. So if any stock has a beta of 1.5, that means it is having 1.5 times the risk than the market. 1.5 times the risk than the market. So market risk is always 1. Remember, market risk is always 1. Remember, very important. Market risk is always 1. So The various interpretations of beta, very important again from exam point of view. If beta is more than 1, it is known as aggressive stock. It is known as aggressive stock, giving more return than the market. Giving more return than the market. If it is less than 1, giving less return than the market. Giving less return than the market. Example, pharma stocks less than 1. Real estate stocks more than 1. And if beta is equal to 1, which is equal to the market. Right? Any questions on beta?
One question, please.
Yeah.
Basically, this beta value, so which means the market is behaving in X level. That is, for example, take a particular script called some industrial company.
Right.
It keeps on going up at X amount of value. And
right.
A company which is in the same segment, same, say for example, petro industries, the
right.
same company is in the same industry, but its growth is not that very high or whatever it is. Then
Correct.
it means beta value is lesser.
Yes.
So this company's risk factor is lesser, or company's earning factor is lesser.
Okay. Now, when you talk of two companies which are of same industry, I'm just trying to interpret your question.
Yeah.
Both are belonging to the petroleum industry.
Okay.
One company's earnings is increasing and other company earnings is not increasing.
No, not on company. Company's profit is increasing, but the sector's price, for example, BSE is increasing at 10%. But this company's BSE in that particular petro index scripts are increasing by 10%, whereas this company's price is increasing at 8%. So it is less than 1. Okay.
Right.
So in that situation, does this company shows increased risk or decreased profitability? Which one is right?
Okay. So this company is showing decreased profitability, and because when I say there's a beta factor for this particular company, which you are saying that it is less than 10%, which is normally the market rate of return, and there's another company which is showing a higher return belonging to the same industry. Yeah. So when I say this is the company which is earning less, whether there's a decreased risk or lesser profitability, that is the question.
Yeah.
Okay, great. So let me tell you, decreased return does not mean that there is less risk. Decreased return does not mean there's a less risk. Here the question may be that because of this company might have certain specific characteristics. That is why it is earning less return. And if you see this formula on the screen, RF plus RM minus RF into beta plus alpha. Now this alpha is a risk factor which is specific to this particular company, or the deviation of that particular company from the industry standard. This alpha is a deviation which normally your company is showing, which other companies are not showing. And why it is showing? Because that company might be having certain additional risk factors or some other factors. That is why there is less. So in general, the beta would be same as the market, that is 1. But because this company is having certain alpha factor, that is why there is less. Is this clear, Mr. Rajan? Okay.
I have one question.
Yes, please ask.
It could be hypothetical, but it is definitely possible that there could be a company where
chartered accountants are used to all the hypothetical situations.
Yeah, okay. Yeah, sure.
We are always giving a true and a fair opinion, not a correct opinion.
Yeah, sure. Now, if a particular company we are valuing, and I find that there are no comparable market available for that, right? Like for example, there is no listed entity which is equivalent to the business of the company, the same as the business of the company. There's no other, or they are very very, very, sketchy information is available. In
Yeah,
regard to
thinly
market.
traded, thinly.
So in
thinly
such
traded.
cases, the beta, how do we take the beta? That's,
Okay, so beta is always, remember, it is based on the industry averages. So if you're trying to compare your company with the market return, and the company which you are trying to value is not listed, that's what you're trying to say?
no, there is no comparable company listed. There is no, I mean, it's a new business, absolutely new business. And just as I mentioned to you, there could be a very new business.
Right. Okay. So we need to calculate the beta for the new company.
What do we assume? We assume 1 there, or I mean, what do we go?
Right. Okay. So you mean to say that we are trying to value a company which is very new, and if you want to calculate the beta for that new company, how do we arrive at the value of that beta? Am I right? When we don't have any comparable.
Yeah, where there is no other company from which data is available.
Correct. So let me give you an example. Let's say if you're trying to value a company which is into artificial intelligence, correct, today. And today we don't have any company which is listed in the artificial intelligence space.
Sure, exactly.
And if I want to value the beta, how do we calculate that particular beta? So there are two, three ways where you can arrive at that particular beta. One way, as you said, that we take the beta as 1, because that is what is the normal market beta. So we take it as 1. But because that artificial intelligence company has got certain risk, which should be there. Now, so how to incorporate that risk? So what we can do is we take the beta as 1, and when we calculate the cost of equity, we add additional risk, which is very specific to artificial intelligence company. Because I don't have a relative market company, listed company. So I am taking a beta as 1, but I am adding additional risk, which is not in terms of beta, but in terms of adding certain percentage to my discounting factor. So let's say from CAPM formula, I have calculated this, the cost of equity as 12%.
Right.
Taking beta as 1. But when we are discounting it, I will not take 12%. I will take, let's say, 17%, because I have added 5% as additional risk, which is specific to this company based on my judgment.
So
not
judgmental. Okay. Can be more judgmental.
Yeah, that is judgmental. Again, as you said, this is all a lot of inputs which are very subjective. That is why valuation cannot be very objective. So that 5% is an additional risk which you have calculated based on your perception.
Yeah, why I'm asking, it is helpful. But why I'm asking is, this could be a contentious point between valuer and the company, because that's where.
Yes, that is always a contentious point. That's not that it is always there. So that additional risk which I am trying to mention could be, the way of, adjustment factor of arriving at a particular value. Because that, see, normally we cannot go beyond, let's say you are taking a 5%, but I cannot take 20%, which is very abnormally high. So it has to be within a range. So anything which is a range of 4 to 10% could be an additional risk. But going beyond that is always difficult. But yes, that is always a point of contention. The other way, if you're not taking beta as 1, what we can do is, we can take the beta of, let's say, because this is an artificial intelligence company. So we assume that the beta of a IT company could be relevant, not exact. So we take the beta of an IT company, and then you make adjustments to that particular beta of that IT company, and you can recalibrate that particular beta of IT domain. That is how it is done. But normally taking beta as 1 and additional risk factor has to be incorporated. That is the normal way normally valuers would adopt.
Okay.
Because we don't have any comparable there.
Okay, thank you.
Okay. So friends, going back to the formula, basic formula again. Yes.
I have one more question on that.
Yeah, please.
If a particular company has a beta less than 1,
yeah.
So does that mean it is a low risk company?
Yes, when beta is less than 1, it means, see, it does not mean low risk. It means that the return of that particular company would be less than the market. So that means if the return is less, obviously the logical assumption is rational, says that return is less, the risk would be less. That is a rational thing. But Indirect, what we are trying to link, that we are trying to, beta gives a reflection of the stock movement with respect to market. So less than 1 means there will be lesser volatility, lesser risk, lesser volatility. So let's say when the market is going down, when you see that there is a lot of tension on the border because of China, and you expect that the market is going to remain volatile. So in that scenario, if you invest in those stocks which are less than, having beta less than 1, probably the downfall on these stocks would be less in comparison to stocks having beta more than 1. So beta in effect measures the volatility of the stock with respect to market. So in general, when I say terms of risk, risk means the volatility, the changing factor. So that does not mean the lesser return. It will give you return, but less than the market, because obviously the fluctuation is less.
Okay, sir.
That does not mean that does not mean the company is not in good shape. Let me tell you, that does not mean the company is not in good shape. The company might be earning high, but the market does not give us that earning a much high regard in terms of the risk factor. That is why it is giving less return than the market.
Thank you, sir.
Yes. So going back to this formula, friends, we have understood the concept of present value. That for present value, we need to calculate KO, KE. KE, I have given you the formula of CAPM. We have explained the terms beta, the risk RM, risk return on the market, and the word RM minus RF as the risk premium. Now, remember when the term comes in RM minus RF into beta, again, remember friends, there are two interpretations now. When I consider independently RM minus RF, that is risk premium. Now, when I consider RM minus RF into beta, RM minus RF into beta, that is the risk premium of that stock. Remember, because when we are considering the beta, I'm taking the beta of that particular stock. So equity risk premium is RM minus RF into beta. Stock equity risk premium is RM minus RF into beta. And only purely risk premium, that means the market risk premium, is RM minus RF. See, these are normal exam questions, and people get confused that whether I should pick RM minus RF into beta or only RM minus RF. So when it is equity risk premium or stock risk premium, RM minus RF into beta. When it is purely risk premium, it is RM minus RF. Okay. Now we coming to the second part, is the calculation of terminal value. Now, terminal value, as I mentioned, that terminal value is the value of the firm at the end of the growth period. Remember, terminal value is the value of the firm at the end of growth period. So how do we calculate this terminal value? One simple way could be, in simple context, the terminal value is basically, if you have invested in a company and let's say you want to remain invested for 5 years. So after 5 years, you are going to sell your stake or sell the business, let's say. So terminal value could be, and another word could be the exit value after 5 years. That what is my exit value after 5 years? So that is another term which is used. Now, after 5 years, what would be my value? So there could be different ways of calculation of terminal value. So it could be based on relative valuation, that after 5 years, I could find a relative valuation method to find out that what could be my exit value. I can calculate the stock price of the company after 5 years. That could be another way. Or terminal value can be calculated based on the discounted cash flow method. Now, terminal value after 5 years, a simple, logical, rational way of valuing any company is what? It is based on future cash flows. It is based on future cash flows. So terminal value after 5 years will be based on the future cash flows after 5 years. Terminal value after 5 years will be based on future cash flows after 5 years, which is forecasted till infinity. Which is forecasted till infinity. So another simple way, friends, remember, terminal value is nothing but value of perpetuity. Terminal value is nothing but value of perpetuity at the end of 5 years. And what is my 5 years? Growth period. So terminal value is nothing but the value of business at the end of growth period, incorporating the future cash flows till infinity. Incorporating the future cash flows till infinity. So terminal value is the value of perpetuity till infinity after the end of growth. In technical terms, terminal value is the value of the business at the end of growth period, or the value of perpetuity at the end of growth period till infinity, right? Now, how do we calculate it? Now, can you tell me, if 5th year is my end of growth period, and if terminal value is calculated based on future, so future means 6, 7, 8, 9, 10 till infinity. Do we all agree to this? Yes. How do I calculate the cash flow for 6th year? How do I calculate the cash flow for 6th year?
Adding growth rate to it.
Adding growth rate to what?
Adding fifth year cash flow.
Perfect. Absolutely perfect, friend. So we take the free cash flow for 5th year. We take the free cash flow for 5th year, and we apply growth rate. We apply growth rate. So if you see the formula highlighted in red, free cash flow for end of 5th year. Remember, very important, friends. Free cash flow at the end of 5th year. Now, can you tell me what is 5th year? In
Terminal
our
value. Terminal value.
No. 5th year is what?
Beginning of our stable period.
No.
FCFF T underscore T.
No. In simple words, it is end of the growth period.
Yes.
5th year is end of the growth period.
Correct.
So FCFFT is the free cash flow at the end of growth period.
Correct.
FCFFT is the free cash flow at the end of growth period. So my 6th year cash flow will be applying the growth rate.
Yeah.
Into 1 plus G. Into 1 plus
Stable
G.
Growth rate.
Upon K minus G. K is nothing but the cost of capital. Upon K minus, this is the value of perpetuity. Formula for perpetuity, present value of perpetuity. Upon K minus G. So this is terminal value. Whatever is highlighted in red, not in black. Highlighted in red, that is the terminal value. So if somebody asks you what is terminal value, what is your answer, Mr. Ashok? Terminal value is what?
Terminal value will be
in simple words. So terminal value is the value of business at the end of growth period. Simple words, value of business at the end of growth period. So this is the whatever is in red, that will give you terminal value.
Yeah.
The next step would be to calculate present value of terminal value.
Just for clarity, Mr. Naveen.
Yeah.
If I'm investing in an organization with, for example, 10-year bond, I'm investing. I have consciously invested for 10 years, which means when you do the valuation for that, I presume that 10 years is the end of the growth period. Is that right? When I'm doing your investment today, that is, we are taking in this case for 5 years, because that is the easy, nearest possibility. We calculate the free cash flow. So, but the point is, I am investing for a 10-year bond. Some in a company, I am investing as a 10-year bond for which I am doing the valuation for that purpose. So when I will have to do the free cash flow for 10 years, and on the 10th year of whatever be the free cash flow available, I have to put the growth rate and then calculate. Am I right in the assumption?
Yes, right. So there are two different perspectives. What you have mentioned is correct. So you are telling from the investor's perspective that if I'm investing today and if I want to invest for 10 years, I want to estimate what could be the possible exit price.
No. I'm only talking about the end of the growth period. What is the end of the growth period?
That's what I'm saying.
Somebody has to determine. Yeah.
That's what I'm saying, that you are trying to estimate the 10-year exit price based on your estimation that you are investing for 10 years. Correct? So your horizon
Correct.
is 10 year. That is why you are estimating the price at the end of 10 year. And for you, that 10 year would be the growth period.
Okay.
Right. But let's say in the
Right.
valuation world, what will happen? The company would come ask you that I want to value my company. So in that case, you need to tell that, please give me a forecasting for next 5 years. And as per my perception, 5 years would be the growth period.
Oh.
So there are two different perspectives which you have asked. From your perspective, you are correct because you are talking from the investor's perspective. So maybe you are looking at a 10-year horizon because after 10 years, I want to sell my investment. So I need to know my terminal value. That is the exit price. That is why I mentioned there are two terms, either the terminal value or the exit value.
Exit value.
So, yeah. So from your perspective, you're trying to calculate the exit value after 10 years, which actually is a 10-year growth period. Yeah, holding period, which in turn means holding period. For you, it is a holding period. Yes.
It is not expected that after 10 years, the unit is going to be closed. That is not the intention. But as far as my perception is concerned, at the end of the year is growth period.
Right. So for you, it is a holding period, right?
Okay. Thank you.
Right. So friends, terminal value, and the next step is calculation of present value of terminal value. Remember, present value of terminal value. Now, very important. Please note it down. Very important. First is, what is the possible growth rate after 5 years? What is the G? G is equal to what? How much?
Inflation.
Correct. So friends, remember, from the practical perspective, nobody will give you any growth rate that my business will grow at the rate of 10% after 5 years. So normally what we assume that G would be normally equal to the prevalent inflation rate, because any company would like to at least grow at that particular rate till infinity. So therefore, if any question comes in exam, this growth rate is equal to what after in the stable period, not currently. Remember, in the next 5 years, the company is expected to grow abnormally, explicit hai, zyada grow karega. It is expected to grow at a higher rate. But after 5 years, the growth rate will be equal to your inflation rate. Remember. The second thing which you need to remember, the cost of capital for stable period might be different from the cost of capital of the growth period. Might be, not 100% always it will be like that. It might be. So there might be situations when I'm talking from exam perspective, in questions, there might be two discount rates. One discount rate for the stable period and one discount rate for the growth period. Remember, there could be possible two discount rate. One discount rate for the stable period, another for the growth period. That might be possible. Now, what to use, how to use this discount rate? Remember again, for calculation of terminal value, very important friends, common mistake committed by every participant. For calculation of terminal value, discount rate for stable period. Discount rate for stable period to be used. But for calculation of present value of terminal value, discount rate for the growth rate to be used. Very important. These are the two important things which you need to remember, friends. Okay, so that was about the terminal value, then the present value of the terminal value. So going by the formula again, just trying to recall that formula. Friends, we have understood the terms present value, we have understood the term growth period, we have understood the term terminal value, and we have understood the term present value of terminal value. So the only now term which is left is known as FCFF and FCEFC, which we have already discussed. What is FCFF and what is FCEFC? Yes, any questions? Somebody was asking me a question.
Yeah, the stable period growth rate.
Yeah.
I think you had earlier mentioned inflation. The slide says real return of 1 to 2% plus inflation.
Yes. See, normally when we assume that there'll be a growth period, which if there is nothing mentioned, as I said, that there's nothing mentioned which you are not able to estimate, we should take it as a equal to inflation. But when it comes to an estimation that what could be the possible growth rate, if the management says that, I will be growing at 15%, then in that case, you need to ensure that that 15% is equal to inflation plus a real rate of return of 1 to 2%, because we cannot expect any company to grow at a rate of 15% till infinity. So your range of G has been given as inflation plus 2%. That is the maximum range which has been given.
Okay, but inflation is also subjective, there are some years there is inflation, some years there is deflation.
So we take an average, let's say in Indian context, if we see, we take an average of last 15 years inflation rate. That will remove all the subjectivity, which is a reasonable time period. And if you think that 15 years is not a reasonable time, you can extend it 20 years. But somewhere we have to try to put in a limiting factor.
Still
so that is why,
but still the terminal growth rate, anything about 2-3%, if you take 8-10%, the valuation becomes, the DCF valuation becomes, pardon my words, it becomes a mockery. I've seen people trying to adhere to management's requirements by simply fudging this number.
The growth rate?
Yeah, the terminal growth rate.
Yeah, terminal growth rate, I don't know why, but terminal growth rate cannot be, more than 6%, 7%, and cannot be less than 3%, 2 to 3%. 3% is a very reasonable thing, and 7% could be on the higher side.
Exactly.
Now, that is the normal range. If anybody is taking beyond 7%, I think then we are talking of any industry which is going to boom up in the next 25 years. And we all should leave the profession and invest the whole amount in that business. If somebody is trying to maintain that, that is a growth of 7% till infinity, that's a very normal rate. So 3 to 7 is a reasonable range.
Yeah, I just want to add that I've done few valuations. Anything beyond 3%, there's a huge difference between 3 and 6 itself.
Yes,
simply
I agree. When it comes to terminal value, any deviation of 2% is bringing a huge difference in the value.
Yeah, and most professionals, may not be the right context here, but most professionals try to use that figure to this thing, and they, it becomes very difficult to talk academically to them because they think they can fit any number there. It's my wish, that's how I have seen so far.
Maybe it might have happened, because in mine and in whatever valuations I have done, I have taken a range of 3 to 5%. That's what I have done. Mostly it has been 4% or 3%. In very normal case, I have maybe in one or case I have taken might have 5%, but it is normally 3 to 4%. 3 or 4. That is the reasonable thing which I have expected.
And what I do is I extend the growth period projection for 10 years. Have realistic numbers what management wants there, but have my terminal growth rate after 10 years at 2 or 3%.
Yeah, so that is also that is always subject to management thought process, that if they are able to forecast till 10 years, that is very good, because the longer you go, you try to remove all the averages, right? So that is always a good factor that you can forecast it for 10 years. But 5 years is a reasonable time period, and going anything beyond 5 years is always good for the valuers. But from management perspective, they find it difficult. So that is why normally 5 to 6 years is taken as average.
Right.
Okay.
I have one question.
Yeah, please, sir.
Going back to the various methodology of valuation, it's possible that, for a company valuation, one particular methodology may not fully fit, whether it's a DCF or a net of assets, net asset value, all those. Can, as per international valuation, possibly a hybrid or a blended rate is allowed? So
yes.
So do we have to really? Is it? One can always give an explanation as to why we are taking a blended rate, right? And then we can always go for the hybrid rate.
Yes, blended rate. What I mean to understand, what I get to know, blended rate means we use two methods, and we take average of two methods.
Right. But is it generally acceptable? Is that
Yes, why not? Why not? I mean, you have always a right where you have adopted the valuation methods as per the valuation standard, and you think that both are the methods which can be applied to this particular company, and you're taking an average of these two companies. That is a possibility. Why not? You go for relative valuation, you go for DCF, and based on that, you're going for the average part. Not a problem.
sure? Okay.
And if you go to the pre-compulsory arena under the Companies Act, where now it is compulsory for the registered valuer. But before that, if you see all the reports, the maximum reports had followed an hybrid approach
Yes.
of valuation.
So the weightage that we ascribe to that, for the 2 or 3 methodologies, that again, can be at the judgment of the valuer. I mean, as a valuer.
Yes. That brings in the subjectivity. That weights which you are trying to assign is you are assigning. See, when you are giving it equal weight, so there's no doubt about it. I mean, nobody would question that. But when you are trying to give a higher weight to a particular method, you need to justify that, and that again depends upon the subjectivity of the valuer. So that again creates that subjectivity element in the whole valuation approach.
Okay. Thank you.
Right? Yeah. So friends, what we have done, we have understood 2 methods, that is the DCF and the relative valuation. We have one more method to be covered, but I believe now the time is over. So nothing to worry, we will cover that particular method. Tomorrow I am having again another class with the all people on valuation with specific situation. So the third method, which is the least preferred method and a very small method, which will take around 5 to 10 minutes to cover up. So we'll cover up tomorrow. When we start the session, I'll start with this third valuation, the asset valuation, and we'll cover up that technique in the tomorrow's class, and then proceed with the next chapter of the valuation. And if you have any questions, you can always raise it tomorrow with all the doubts, when we can have another thought process. I think after having this today's session, what I found that one of the most interesting sessions which I had today in terms of the question answer part. And because of this question answer, a lot of doubts get cleared, even for all the participants. That shows the interest of all the participants in this whole valuation course. And even at times, we also get a lot of thought process clear when we try to answer all these questions. So that's a very good part. Vijayji, I think the participants have been very active. Kudos to you and the participants who have come down to attend this particular lecture session on valuation. And probably all the faculties will have an exciting time in the next 7 days.
Actually, the participants is also limited. That's why Ramanji and Ashokji and Sivaji. All the 3 participants are kept their video on always.
Nice.
That shows they are much more active. Even at the time when I attended the class, I was not so much active. But fortunately, I cleared my exam in first attempt itself, even within a week time.
Very good, sir. बहुत बढ़िया से बधाई हो. Congratulations.
Thank you. Thank you very much.
Thank you.
So our next session will start after lunch. So we are taking break of 1 hour. We will start at 2:45.
All right, sir. All right.
And also request all the participants, after completion of this course, immediately enroll for the exam. Don't worry about whether you will clear or not, because we are now not the students, we are the professionals. So don't intimate your child that you are going to appear in the exam. Because that is the most embarrassment thing, that you are informing your child that you have not cleared the exam. Simply you are going to the office and appear for the exam. There is no number of limits. Simply we have to invest 1,500 rupees. And if you have attended the class immediately and attended the exam, then your mind is fresh. Nothing is nowhere involved in other activities. Otherwise, again, being chartered accountant, we will enroll in audit, taxation, or other work. So, thank you. After lunch, Mr. Company Secretary S. Dhanpalji will join for insolvency and bankruptcy code, including Companies Act. Thank you.
Thank you.
Thank you very much, sir. Thank you. Thank you, sir. Thank you, sir.